Hi. In our article, Three Tax Reasons Your Small Business Should Be an S Corporation, two of them were pretty self-explanatory. Shifting income to a lower bracket taxpayer. A lot of times this happens if, you can gift it to your parents, you can gift it to your kids. Makes a lot of sense. You can gift it to anybody else, actually, who might be in a lower tax bracket. Um, Avoiding audits also, just simply, S corporations just audited probably 1/7 of the amount of time. You lower your audit percentage by almost 700%. Why? It's really kind of weird, but the IRS, the way they're set up, new auditors come in and they graduate up to the corporate level, and then those that are pretty good get to the bigger corporations. They really don't look at the smaller corporations as much. They keep saying they're going to improve this, but year after year I see this just not happening. But here's the reason that 87% of small businesses are set up by, that's the last statistic I saw, that close to 85 to 90% of businesses are set up as an LLC or a corporation that elects S corporate status. All right, and there's a lot of confusion here. All right, LLC is a strange little bird animal. I have had people tell me, "Oh, I'm an LLC, so I'm incorporated." Well, LLC doesn't really exist for IRS purposes. It's a chameleon. It basically is taxed either as a sole proprietor, a partnership, or a corporation. In fact, the IRS default position is if it's a one-person LLC, it defaults to a sole proprietor. If it's a two-person LLC, it defaults to a partnership. And the reason is pretty simple. It's the worst way to be taxed. It increases your taxes dramatically. And let's go why. Let's start with looking at this part of it first. Let's take a sole proprietor who has business income over $200,000 but ends up with taxable income of $100,000. All right. This is their taxable income. We don't really care what their tax rate is. But let's just assume 20% for this example. And they got $20,000 in personal tax. Social Security and Medicare is 15.3% of their taxable income from their business. So their total tax, and I'm assuming that all their income on their tax return comes from their sole proprietorship. So their total tax is $35,300. Let's take it. Now this would be the same whether they were a partnership and their share was $100,000. Tax would be the same. Let's take an LLC or a corporation that now instead elects to be taxed as an S-Corp. Now, an S-Corp doesn't stand for small corporation. S-Corporation is actually subchapter S of the IRS tax code. Who cares? Everybody kind of calls it a small corporation now. This allows some things to be done differently. For example, the biggest difference is that only your salary that your owner is going to receive is going to be taxed. The amount in excess of the salary is not going to be. Now I'm talking about for Social Security. Everything's taxed for income tax. For Social Security, only the owner's salary is going to be subject to self-employment tax. The excess is not. Why? Well, the theory is basically that the owner is going to get paid what they're worth, and the other. In my example here, I have $100,000. $60,000 is the owner's salary, and a corporate taxable income of $40,000. The theory being that other $40,000 arises because of the goodwill of the company, the assets the company has, including its customer list, which is often its most important asset, and the work that's added by their employees and their investment in equipment and investment in their sign, investment in advertising. So basically, it's not under the code, it's not considered self-employment income, and thus is not subject to self-employment tax, which is the same equivalent as Social Security and Medicare. The difference is if you're on a W-2, you pay half of this 15.3%. And your employer pays the other half. Don't let that fool you. You pay both halves, because when I'm hiring somebody, if I didn't have to pay that to Uncle Sam, I might be able to pay it to them. All right, because I have to justify that. Now, some smart CPA, I would call him a dumb CPA, decided, hey, I just won't pay myself a salary, and that way I don't have to pay Social Security. The IRS is on the lookout for that. You have to pay yourself a reasonable salary. Now, reasonable is up to interpretation. I would say, follow the old rule: pigs get fat, hogs get slaughtered. All right to be a pig, don't be a hog. put some salary down there. What it would be, I always ask my clients, what would it take to hire somebody to replace you? That's probably what you should pay yourself. All right. But let's just go back to my example here. Got $100,000 of which they receive 60,000 as a W-2, and the other 40,000 they receive as a K-1 from the company. Now their taxable income from this business is still $100,000, just like it was under the sole proprietorship or a partnership. But instead, their income tax is still going to be $20,000, but only 60,000 is subject to Social Security at 15.3%, $29,000. Their total tax is $29,000 instead of $35,000. They're getting an income tax saving of $6,120 every year. All right. The nice thing about setting up your structure this way is you're able to avoid tax. Now, how I said $100,000. If you make more, your savings is going to be more. Medicare is now 2.9%, unlimited. You make $2 million, you're going to pay 2.9%. Social Security, I forget what it tops off at this year, 118, 120,000. Who cares? It changes every year, and I let the computer figure that out. All right. Now, there's some downsides to being incorporated. In Texas, we have a franchise tax, additional cost of incorporating. That missed. Take two. All right, I passed this example out to people in Texas because that's where I'm at. So we don't have an income tax; we have a franchise tax, and it's on businesses of less than $1 million for 2 million. For businesses more than $1 million in gross sales. So you want to take into account what's the corporate tax. In states that have a corporate income tax, they also have an individual income tax. So it just comes down to math. You want to see your CPA on that. You're going to want to incorporate online around $600 in Texas. Yeah, with a lawyer between $1,200 to $1,500. This is kind of a one-time fee. You're going to have an extra tax return that your tax preparer is going to do, somewhere between $750 to $1,250 a year. All right. You want to compare these extra costs and make sure they offset by the savings. That's pretty much where you're at. Almost obviously, you can do the math. 99.9% of the time, the savings is well worth it. There's other advantages to it, like we talked about. You have you've got some liability protection. The obvious reasons to incorporate. You're shifting income to a lower bracket. You can avoid audit. So a lot of this stuff is pretty straightforward. This is a good example of why just about every business that makes enough money, if you got 80,000 or more, that's about right. 70, 80,000 in profit, you probably should be an S-Corp. Until next time, let's make this our most profitable year ever. Thank you very much.